I do believe that the structure of the gold and silver market lends itself to near-term manipulation. The extraordinarily leveraged nature of the futures market and the fact that the futures market often trades on a daily basis 100 times the amount of metal available for settlement means that the ability for well-heeled speculators to get, as an example, short on a laddered basis in the futures market, gold or silver.
Rick Rule, the founder of Rule Investment Media, believes that the gold and silver market can be manipulated in the short term. This is due to the functioning of the futures market, where traders can buy and sell large quantities of gold and silver contracts without owning the physical metal. Well-funded speculators can take advantage of this by selling borrowed gold and silver when the market is weak, causing prices to decline and enabling them to make a profit. However, it's important to note that the ability of skilled speculators to manipulate gold and silver prices in the futures market doesn't necessarily indicate a deliberate effort to keep costs depressed over time. Gold has had an exceptional week, rising dramatically after releasing last month's CPI index earlier this week. However, market participants must be laser-focused on gains or losses about dollar strength or weakness. The dollar has been the largest influence on daily price change. Rule believes that the decline in gold prices is primarily due to the value of the US dollar going up compared to other currencies. However, over the last week, the dollar has dropped considerably. On July 15, 2023, the dollar index closed above its opening price and the previous day's close, marking the first day of an upward movement following consecutive lower pricing. This came after hitting the lowest point of a correction and the lowest level since April 2022. Spot gold is currently fixed at $1,954.30 after factoring in today's decline of $5.70. The decline in physical gold results from a combination of dollar strength and fractional selling by traders. Dollar strength resulted in gold declining by $3.90, in addition to traders providing fractional selling pressure, taking physical gold lower by another $1.80. Now let's watch excerpts from Rick Rule's interview with Liberty and Finance. Be sure to watch the entire video and consider subscribing to our channel. Remember to enable post notifications to stay updated on our latest uploads. Thank you and enjoy the video.
I don't believe that there is any thorough ongoing conspiracy on the part of any competent conspirator to depress the price of gold and silver. The price of the US dollar is increasing in every currency in the world, except perhaps gold, of its own volition. So, of course, the gold price declines in U.S. dollar terms over time, as long as the U.S. dollar is strong. I believe that the best days of the U.S. dollar are behind it, despite its price appreciation. I believe that the salad days, if you will, for the U.S. dollar was the period 1982 to 2022. I think a lot of things changed in 2022. I think that the relative strength of the U.S. dollar relative to other currencies in the pace of U.S. interest rate rises, which have been stronger than interest rate rises in other currencies, I think that the U.S. dollar has underperformed on a relative yield basis to the other currencies, which tells me that we're seeing the beginning of the end of U.S. hegemony, not U.S. supremacy. I think U.S. supremacy continues for my lifetime, but I think U.S. hegemony is over. So I don't think that anybody who is competent to maintain depressed levels of gold and silver prices over time is doing it. Means that the ability for well-heeled speculators to get, as an example, short on a laddered basis in the futures market, gold or silver, and then overnight during the period when the physical market is at its most illiquid, dumping fairly large amounts of gold and silver, which triggers disproportionate decreases in the futures market. It would be perfectly possible to construct a $10 billion futures ladder with $1 billion in deposits, and then sell probably borrowed gold, $1 billion worth of gold overnight during a period of time when the gold market was weak, depressing the gold price by, let's say, 5 or 6%. We've seen that happen a couple times, and have that expressed in the futures ladder at 7.5%, thereby making a $750 million profit against a $2 billion investment. Not bad, for 3 or 4 weeks worth of work. And we have seen both ladders and spoofs in various financial markets as long as I've been involved in financial markets. You will note, or maybe your listeners won't, because most of your listeners aren't my age, that it's very likely the gold and silver markets were manipulated in the 70s too, except they were manipulated up. You manipulate markets in the direction that is the easiest to manipulate them. I know I'll get a lot of hate from your viewers about that, but that's okay. There were arguments about manipulation in the whole period, 1980 to 2020.
During the interview, Rick Rule also highlighted backing currencies with gold. He pointed out that countries like China and Russia, if they were to back their currencies with gold, need to possess sufficient gold reserves to support a liquid currency that can meet the needs of their citizens or the global economy. According to Rule, the motivation behind countries like China and Russia exploring alternative mechanisms to the U.S. dollar is the weakening and weaponization of the dollar by the United States. As the purchasing power of countries holding U.S. dollars diminishes more rapidly than the yields they receive on U.S. Treasury securities, these countries seek alternatives. The BRICS mechanism is considered a response to the vulnerability of the U.S. dollar as the world's reserve currency. Rule suggests that any trading system established outside of the U.S. dollar and the SWIFT banking system, even if denominated in a different currency, would still be tied to the U.S. dollar in some way. Let's get back to the interview.
If you look at the amount of gold that China and Russia have to back a gold-backed currency, assuming that China and Russia would like to use their gold to back the currencies of South Africa and that serial defaulter Argentina, if you look at the amount of gold that they have to back a currency, where that currency would be liquid enough to serve the needs of the citizenry of those countries, never mind the world, they don't have anywhere near enough gold. So how do you back a gold-backed currency with no gold? Secondly, if you view the currency as gold-backed in the way that the U.S. dollar used to be gold-backed, perversely if you weren't American, because the U.S. dollar wasn't convertible by Americans, only for foreigners. Let's say, Dunnigan, that just for fun, you had 100,000 bricks and you wanted your gold. And you go to Russia and you deliver your 100,000 bricks and you say, "Where is my gold?" to Russian sovereign courts facing the Russian army. What do you think the probability is that you get your gold? Doug Casey famously said the U.S. dollar was an IOU nothing. The euro with 17 backers was a who owes you nothing. If that's true, the brick is a nobody owes you anything. Let's look at the constituents of that. Brazil, non-convertible currency, opaque financial markets, almost no domestic government debt market, certainly no international government debt market. And that international government debt market that there is denominated perversely in U.S. dollars, a deep and liquid currency. In truth, every country in the world that borrows in U.S. dollars does so for an interest rate that's substantially below the interest rate in their own domestic currency. So you have a new quasi-currency that's put together. A currency where the constituent countries, all have their own political and politically expedient domestic governance. The chance that this currency would ever be liquid in a retail sense is nil. People hear me say this and they say, "Oh, well, the demand for gold that I hoped would arise won't arise." That's exactly the wrong conclusion. The reason that the BRICS are attempting to create a medium of exchange outside the U.S. dollar is precisely because Washington has weaponized the dollar, is precisely because the purchasing power that countries like China that own U.S. dollars are experiencing, the deterioration in the purchasing power is greater. than the yield that they're receiving on their U.S. Treasury securities. The circumstance that causes countries to try and put together a mechanism as clumsy and as ill-suited as the BRICS is precisely the weakness in the world's reserve currency, the U.S. dollar, and is precisely the reason why someone should own gold. Will some BRICS mechanism evolve that will allow Russia to trade with China, China to trade with Iran, Iran to trade with Brazil, outside of the SWIFT banking system, and at least partially outside of the U.S. dollar? Yes. But ironically, that trading mechanism, although it will be denominated perhaps in some currency other than the U.S. dollar, will end up being tethered to the U.S. dollar. And repeat, it will not be backed by gold. Or if it's backed by gold, it'll be backed in the same way that bank deposits are backed.
The gold and silver markets are likely to remain volatile in the near term, but likely to remain valuable assets in the long term. In the long term, the value of gold and silver is likely supported by the increasing demand for these metals as a store of value and a hedge against inflation. The rise of China and other emerging economies is also likely to increase demand for gold and silver as these countries seek to diversify their reserve assets. Do you think gold and silver are still good investments in the long term, and why or why not? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.